Dan, we in Action Alerts Plus just got back into the Facebook position, and we used the weakness from the WhatsApp acquisition to do so. How do you play it for AAO, Action Alerts Options?
Yeah, well, you know what's interesting about it, the options market, when you see such a significant corporate event, like you saw, Facebook take 10% of their underlying stock price or their market cap and make an acquisition the size that they did at WhatsApp, you had that weakness, and like you said, it gave you an opportunity to get back into the name. You see tremendous growth opportunities. To me, it's kind of interesting from the options market, there was slightly increased options implied volatility. What does that mean? It means the price of options for Facebook went up because of some new uncertainty, because of the fact that they're actually using some of their cash and they're using a good bit of their stock, which could be a very dilutive deal in the future, who knows, for their stock. So the price of options went up while the stock went down. And so what does that mean to me? That means that there is increased concern about the potential situation around Facebook. And so, with the stock just a few percent from the all-time highs, what we did as an alternative to a long stock position, now, I think this is very important. You guys had 100% gains last year in the stock. You were waiting for an opportunity to get back in. You started very small, it sounds like.
Did.
And so to me, it's set up as a good opportunity to create a defined risk, long exposure position, looking out a few months rather than just owning the stock, especially if one of your subscribers had these 100% gains last year and said, I've been waiting to get back in, the team's getting back in, but they're doing it small. You could do so in the options market despite the high price of options implied volatility, okay? You could buy a call or a call spread. So last week when the stock was like 66.5, I think that's when you guys re-entered the position. We looked out to June. We wanted to give the idea some time to play out. And we defined our risk, and we bought just a call spread. And really, that doesn't sound nearly as complicated as it is, but it's buying one strike call and selling another higher strike call in the same expiration. We did it in June, and we bought the June 70-85 call spread. Long the June 70 call, short the 85 call spread. And what did we do here? We basically lined up your price target, about $85, and we wanted to give ourselves long exposure where that spread cost about $11.50. That's my max gain. My max risk was $3.50 to the downside. Rather than being long the stock at 66.40, the stock was just at 55, let's say, 2 months ago. I've defined my risk to $3.50. I've also capped my gains at your price target of about 22% of the underlying stock price. So what I'm trying to do here is, you guys are dipping your toe in the water. I want to create an option structure with defined risk that gives me some good upside exposure over the next few months, but also defines my risk to the downside.
And we know how volatile this stock is, right? So that's exactly why you're taking this kind of an action. I like that. I kind of call it like a hedge, if you will,
Sure.
right? And I like this because it really does protect you on the downside, which we know this market has been very volatile. So these are the kinds of things that you're going to be doing for Action Alerts options.
No,
and I think it's really important, especially when we have the more volatile stocks.
No doubt about it. I mean, you guys have been fantastic. I mean, listen, you have a lot of really nice, boring industrial names.
Yes, we do. We have boring names.
But then there's some really exciting ones.
Right.
There's been Red Hat and Now and Facebook.
Right.
And these are some of the names, despite the high price of options, they make sense sometimes due to the volatility of the underlying stock to actually define your risk.
Perfect.
And so especially as you guys like to trade around, you create a core position, you buy a little when it goes up, you buy a little when it goes down, you trim a little bit when it goes up. But for us, some of the thing for some of the readers out there of Action Alert Plus, I think the idea of maybe adding that additional risk through defined risk in the options market once you've already initiated your stock position could be a really nice way to add potential leverage to the long idea.
Fabulous. Thank you so much.
Sure.
Awesome.